Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me are Sumaira Abdi and Pavitra Pari. Good morning, girls. Once again, markets are trying to attempt a bit of a rebound after going down to levels of 17,000, closer to our 200-day moving average. The low today was 16,996 that we hit just about 30 minutes ago. Since then, we've climbed about 50-odd points, 40-odd points from those lows. But let's see, markets have defended this 200-day moving average despite testing it multiple times. Today as well, there has been that very mini rebound in the last few minutes. That said, the benchmark indices continue to struggle. It's down 0.5%. The banks are underperforming today. Nifty Bank is down close to about 1%. Remember, HDFC Bank will be reporting numbers on Saturday, so that kickstarts the banking earnings. It's largely expected to be a good quarter. The business updates have been strong. So far, all the banks have reported about a 4 to 8% quarter-on-quarter increases in the loan growth, the credit growth rates. So that's fueling a lot of optimism about the banking names. But today, there is that profit booking that you can see. And of course, a lot of focus on IT as well, as always this week.
As always this week. And you're going to bring us up to speed on all of that. So I'll leave that out. But, you know, if you still look at our markets within the rest of the Asian pack, it is still doing better. Of course, we are seeing a cut of around 0.5%. But compared to, say, Taiwan, which is down, it slipped even further. Now it's down 2%. Kospi is down 1.5%. Hang Seng is seeing, sharp cuts as well. So still holding up. What's doing well today is some of the pharma names are actually holding up quite well after 2 days of selling. So those ones will be up for you on your screen. That's looking good. A lot of the auto stocks, they are holding in the green. They are significantly off the highs, but these are the ones which are relatively still performing better. And then on the downside, in addition to some of the financials, you also have an ONGC. There was a big move on crude prices lower, so that one is in focus. And in terms of cues, it is really the US CPI that we're waiting for. So that is going to be the big global cue for us to track, Sumaira.
Hi, morning ladies. So let's get started and tell you all that we have lined up for you today. The market is lower. Key indices are losing about 0.5% each. Financials are taking a bit of a bigger hit, while metals and pharma managed to hold up. Unmesh Sharma of HDFC Securities will join us in a bit to talk about the outlooks for the market.
Markets are still a bit too optimistic about 2023. That is the word coming in from Dan Feynman of Credit Suisse. We'll get you excerpts from our exclusive conversation in just a bit.
ID stocks are in focus on the back of earnings. Wipro slides becoming the top Nifty loser. Hcl Tech, though, surges to become the top Nifty gainer after reporting Q2 numbers. We'll get you key management takeaways from both companies.
And RailTel is on our radar. The company has signed an agreement with NMDC for ICT and digital transformation services. We will be joined by the management to discuss what this means for RailTel's business. So all of this and lots more in just the next 60 minutes.
But let's begin Trading Hour with the sector in focus, and that's IT and two companies that have reported their Q2 earnings, Wipro as well as Hcl Tech. And what a divergent performance from both of them. Wipro was down close to about 5.5%. Q2 numbers were in line with street expectations, but what the street is disappointed with is the December quarter outlook. The company's Q3 revenue guidance at 0.5 to 2% has missed expectations. Also, deal wins have come down on a quarter-on-quarter basis. And finally, it's not that margins, which are at very low levels of just 15.1%, are going to see a runaway improvement. In Q3, the management has already guided that margins will be at similar levels compared to the current quarter. So it's not that there is a big margin recovery, and brokerages have brought down their EPS estimates for, Wipro. We'll talk about HCL Technology as well, but let me invite the management of Wipro. I had a chat with them yesterday, and I began by asking the Wipro CEO, Thierry Delaporte, on why did they declare this modest guidance for the coming quarter.
First of all, the reality is that, we've been growing, as you know, pretty strongly in the quarter two, 4.1% after, and an acceleration after quarter one. If you look at the performance in bookings, very, very strong performance in bookings in quarter two, after a strong quarter in Q1. So actually, we have the volume of business to continue to grow in Q3. Now, what we factored in our guidance is also a certain reflection of the evolution of the market and the reality of the market. No one will question the fact that the market has changed from about a year ago. And in this context, comes the context of furloughs, right? There are furloughs. We know that, it's typically the season of furloughs. And we will discuss, and we are discussing with our clients to see, what's possible and what, what are their expectations. But I think in a market condition where uncertainty exists, and I think it's true for most of the sectors across, Europe and America, we just felt the need to be cautiously optimistic, and that's the context of the guidance we have taken. You will see, maybe we've been slightly cautious, but that's where we felt we were right now, and we will continue to observe the evolution of the market. For now, the demand continue to be strong, and certainly, if we look at the volume of deals to close in Q3, we are also optimistic and positive about the fact that we can deliver another strong quarter in bookings.
Jatin, could you tell us what we should expect on the margin front in Q3 and Q4? Because at that time, there will be no impact, no residual impact of wage hikes. How much can you expand margins from the current levels of 15.1%? What could the exit margin rate look like?
So let me first start with what we shared last quarter. We said that for 2 to 3 quarters, we believe that we will be in this range. And, despite having made investment of a month of salary increases, plus the promotions that we gave from beginning of the quarter, happy to report we are at slightly higher than where we were in quarter 1. Commentary remains the same for quarter 3. We will have 2 months impact of salary increase, and we believe that we will remain at 15% or slightly above is the number that we shared in past, and we continue to see that. It's difficult to call right now for Q4. We don't guide, but clearly the endeavor in medium term is to continue to improve that trajectory and of margin. And this range of 15 that we have shared is for the 2-3 quarters that we spoke about in beginning of Q1.
Jatin, your medium-term margin aspiration is 17 to 17.5%. Given the gap between where you are currently and what your aspiration is, do you think this guidance will be difficult to achieve even in FY24? What, according to you, is the medium-term, not medium-term, but say next year's projection on margins?
Yeah, so Rima, it's a great question, but I would rather not hurry in answering it now. I think we have guided it clearly for quarter 3 and we'll execute on that. But we will come back at right time to talk about that margin aspiration.
Okay, so one more question then. X of the wage impact, are there any other cost pressures that you are seeing? X of compensation, wage hikes, is there pressure, say, on deals, on account of competition?
So Rima, really wage pressure is the largest one, and in fact I would say that if the attrition moderates, which is what we have spoken about in the earnings in the press conference and sort of spoke about it. In fact, it will reduce some of the pressures that we have seen or industry has seen over last 6 to 8 quarters, where we had to hire a lot, many more laterals at higher cost. So in fact, I would say some of those pressures which were existing in prior period are moderating.
Let me take that cue from the word hiring. Saurabh, this quarter's hiring number looks very low at just 600 versus more than 10,000 that you've been clocking in over the last couple of quarters. Is part of the reason, at least on account of the uncertainty, the changing reality of the market, as Thierry put it? I know part of it is because of the base and, you've hired a lot of people in the last few quarters, but is part of it anticipating weaker demand?
So, Rima, as we had called out and Thierry had very clearly said in Q1 when we had spoken to you, we are investing ahead of time. And that's exactly what we had done, with a very clear clarity that as we invest and hire more freshers, we will take time to train them and make them ready. So that was the plan. So it's a very planned thing what has happened in Q2. We had invested ahead of time in Q1, and we have made sure we balance it out in Q2. And going forward, it will be a very conscious effort to make sure, depending on the business in an uncertain environment, whatever the requirement. Only thing I can say is that the supply side will not be a constraint in driving the growth agenda.
Okay, that is Wipro talking about their Q3 guidance. It factors in the changing market realities. So in a way, they are being a bit conscious of the fact that things perhaps could be slowing down. And even on hiring, the management did say that going ahead, they've already made a lot of investments. Their investments in hiring were front-loaded. But going ahead, they will be conscious of the external environment, of the demand, and then continue with their hiring process. On margins, we had Jatin Dalal, the CFO, saying that Q3 margins will be impacted by wage hikes, 2 months of it, and therefore we shouldn't expect a big improvement in Q3 margins. Quite tight-lipped about the medium-term outlook on margins. Let's move on then and talk about Hcl Tech, because Hcl Tech, on the other hand, has reported a very strong quarter. The stock also is higher in trade, currently up. It's the top Nifty gainer with a rally of close to about 3-odd%. So Hcl Tech is the top gainer, while Wipro is the top Nifty loser. As I said, very divergent performance. On Hcl Tech, Q2 revenue strong, in line with expectations. Margins have beaten expectations in the September quarter, expanded by 100 basis points, and margins are now at 18% versus street expectations of 17.4%. Deal wins too have risen on a quarter-on-quarter basis. They've gone up by 16%, and deal wins for Hcl Tech have been very strong. Hiring numbers also, look good, unlike in the case of Wipro as well as TCS, where we've seen a moderation in hiring. For Hcl Tech, the hiring numbers also strong. But what the street really liked is the confidence that the company has, the management commentary, because of which they've gone ahead and raised the full-year revenue guidance. They're now expecting revenue growth to be closer to 13.5% to 14.5% this year. And, for Hcl Tech, there are two businesses. One is services business, which is akin to your Infy and TCS. And the other one is your products business. Now, in the services business, Hcl Tech has said that they will be growing by 16 to 17%, which means it's perhaps going to be the fastest growing large cap IT company in the services business. And that is something that the street is saying. So considering its valuations are relatively cheaper at about 15.5, 16 times, and the company's growth rates are now looking superior with this upgraded guidance, the street, you can see some buying by investors. Margin guidance has been brought down, but that hasn't come in as a big surprise. Listen into what the management had to tell the press yesterday.
Margin performance has significantly improved. We did very well. We posted an EBIT of 18%, which is in line with our desired recovery plan. It's a result of significant operational efficiency measures coming to fruition. We've got good billing rate improvements for all the higher-end services that we are delivering to our customers. We remain very positive of our near-term growth and the medium-term growth. This confidence is coming from the booking that we've had in the first half of this year, and also the quality of pipeline that we have for the remainder of the year.
Our EBITDA came in at 22% for the quarter, and EBIT was at 18%, which is an improvement of about 100 basis points despite the salary increase. This was driven by largely 4 improvement factors. Utilization of the manpower that we have already deployed and hiring, the pyramid that we operate with, also getting better realization from our customers, both from existing renewals and renegotiations, etc., as well as better rates from the new deals that we have signed in the last, say, 1 year, etc.
Happening in the commodity space, as always, Manisha joins in with a focus on aluminum today. Hi, Manisha.
Hi, Samara. Thank you for that. Well, the last 24 hours for aluminum have been nothing short of very, very volatile. We did see prices gain up by 5% overnight, and that is how they settle. But that hasn't been able to hold in the Asian markets right now. We're down by nearly 2%. Yesterday, at one point in time, we were up by 7.3%, and we saw a high of around $2,400 per ton. Well, actually, when you look at the aluminum prices for the month of September, we did see a 17-month lows as well, and the prices ended with 7% of a decline for the month of September. So as I said, it continues to be very, very volatile. In this year as well, when you look at the range for aluminum prices, the all-time high that we hit in the month of April was $4,100 a ton, and then the low has been $2,110 Currently, the prices are trading at below $2,400 per ton there. Well, the reason that you did see that perk or a jump up in the aluminum prices yesterday was after a U.S. statement from Reuters suggesting that the U.S. is perhaps looking to raise tariffs or completely ban Russian aluminum imports. Russia is an important one when it comes to aluminum there because Rusal is the world's largest aluminum producer outside of China. 6% of global aluminum is what comes from Rusal, and we did see nearly 70 million tons per annum of production from Rusal in the last year itself. The other thing that the industry is looking at is the fact that there is no restriction as of now on buying Russian metal. When you look at European Union and US, they actually have imported a lot of Russian metals anywhere between March to June 2022. And we have seen a lot of Russian metal come in on LME as well. But LME also has issued a paper on possibility of suspending Russian metal, and these have led to some premium being added into the prices. But that is where the bullish story ends, because you have China still persisting with COVID policies. There is strength in US dollar. The US inflation is still on the higher side, and a possibility of an aggressive rate hike from US are some of the factors which will continue to see profit taking after every uptick we see here.
All right, Manisha, thanks a lot for getting us that quick update on the aluminium prices. With that, we're going to get into a short break now. For the market, it is actually holding with a cut of around 120 points. So we'll take that break, but when we come back, we're going to Welcome back. You're still tuned into Trading Hour on CNBC-TV18. The market is down around 120 points, so 0.7% in terms of a cut. It is the banks which are seeing a lot of the pain today. So if you can get that chart up, you'll see it slipped even further. Right now, it is down over 500 points, so 1.4% gone on the Nifty Bank. Let's welcome our technical guest on the show, Himanshu Gupta of Globe Capital joins us. Himanshu, good morning and thanks for joining us. We definitely have ourselves a down day. The opening cuts were not too bad, but we've only slipped since those levels. So how would you approach the screen today, and would you have a call on the index level?
Good morning to you. I think both the indices as we speak are close to a very important support zone. So as far as a fresh call is concerned, I think an aggressive bold call for taking longs in both the indices is what I will recommend at this point of time. Because of two reasons. First, 17,000 is actually something that the bulls have been trying to defend from past 2-3 days. A very strong put writing as we speak around these levels and the lower end of this trading zone. So I think with a 50-point stop loss below 16,950, I think a risk reward from these levels to go long is looking very attractive to me. Just in case 16,950 is taken out, I think that's the level when one should be actually strictly exiting from all longs and even can consider going fresh shorts. But till the time that is happening, I think the trade still remains on the long side, and I think on the upside, 17,120, 150 is the first levels to watch out. Once that's taken out, I think another 150 to 100 points rally can be seen in Nifty. Similarly, on Nifty Bank also, 38,500, 38,550 has been the lower end of this zone from the last 3-4 days. And again, I think from these levels, again, the risk reward looks attractive from a 100-point stop loss. One can initiate a long here, and a contra call toward 38,800, 39,000 bounce can be played for today's session. So I think as we speak, we are close to the lower end, and as a contra bet, I would like to go long here.
And stocks, Himanshu?
Yeah, so stocks, two stocks, long and a short strategy. The long is on the market leader, Reliance Industries. That's one stock that's actually showing good strength in today's session, making a higher low on the daily charts. So I think Reliance long can be initiated around current levels of 2370, keeping a stop loss below 2350. And on the upside, targets close to 2420, 2450 can be seen in Reliance in a day or two. The second one is a short on Escorts. Now, this stock has actually given a breakdown from a head and shoulder top on the daily chart. The derivative data is also looking weak. So Escorts can be shorted around current levels for a target price of 1950 and 1920, and a stop loss above 2040 can be placed here.
Himanshu, thanks very much for joining in. With that, let's listen into some important opinion that's coming from Dan Feynman, co-head of equity strategy, Asia Pacific at Credit Suisse.
The problem in the U.S., as everyone knows, the Fed is going to have to be raising rates. We're concerned that markets are still a bit too optimistic about what happens in 2023. I think people are prepared for this year, but we aren't expecting a pivot for the Fed to start cutting rates next year. We think that rates will stay high next year. India, we have some problems. We have a balance of payments challenge. The currency is probably overvalued, but the economy is doing much better than what we will be getting from the US. There is EPS risk, but I'd say less than in the US. PE of India relative to global equities, relative to Asian equities, all-time high. We're in uncharted territory, and that makes our foreign clients feel uncomfortable. The Fed has already made its last hike. You don't want to wait until markets have made their last EPS cuts. You want to get in maybe 6 months in advance of that. So potentially the bottom for the market could come well before the bottom for EPS or the peaking of rates. Well, I think the dollar will probably retain for some time a bias towards appreciation against major global currencies. The rate differential is only going to get bigger. We're not anticipating enough of a change in policies from the BOJ or the ECB, and especially the BOJ, to stop dollar appreciation against those currencies.
Welcome back. You're still tuned into Trading Hour. The market has slipped below the 17,000 mark. Remember, the 200 DMA was at 16,987, so we're less than 10 points away from that mark. So do keep your eye out on the market. But in the meantime, let's get a corporate conversation going. As promised, we have RailTel Corporation joining us now. The company entered into an agreement with NMDC to implement digital transformation services for the miner. To discuss this, along with the business outlook for the rest of the year, we have Sanjay Kumar, CMD at RailTel Corporation, joining us now. Mr. Kumar, good morning, and thank you very much for joining us. This is Pavitra. First off, on this order, if you could just tell us a little bit about it, and what is the size of the order as well?
See, this is the kind of memorandum of understanding we have signed with NMDC. So numbers will be coming in the later part of the year. And we cannot disclose right now, but yeah, this will be a very good partnership. We will be basically partnering with them for their digital transformation.
And your your current complete order book is around 6,000 crores?
It's close to 5,800. Yeah.
Okay. And go ahead.
No, sir, it was 5,800 even at the end of Q1, right? So you're saying that in the last 3 months, there hasn't been any increase in your order book?
No, there has been increase. In fact, we have got close to 800 to 900 crores of new orders.
Okay.
But there are implementations also going on, so which are getting converted into our revenue.
So Q2 order wins were between 800 to 900 crore in Q2?
No, yeah, you were talking about H1?
No, sir, Q1 we know, right? You got new orders worth 662 crore. Wanted to know what the comparable number in Q2 would be.
Q2 numbers, I can only say that since this is a silent period, so we can't disclose that number. That number will be, of course, known to you. But yeah, we will be going stronger in Q2 as well, even stronger than Q1.
Okay, so we're guessing more than 660 crores then in Q2, but you said 5,800 crores is the...
I didn't say any number.
Okay.
So that, yeah.
Okay, all right. So you said 5,800 crores is your current order book. Can you tell us what part of this you're looking to execute in this year, in FY23?
FY23, we expect out of this 5,800 or so numbers, I think we'll be implementing around 1,000 crores or so.
Okay. Could you give us some indication of how big this NMDC order could be? Is it 100, 200? Is it more than 500 crore order?
As I told you, this is not the right time for me. Maybe next time when we interact, I'll be able to share the numbers.
Okay, if you could tell us about the telecom revenue, we did see that it, saw quite a contraction. Can you tell us what's happening on that front? And is this something that we could see reversing in Q2?
Sorry, once again,
the telecom revenue, we did see that dipping earlier. So generally,
this is a cyclical trend has been there with RailTel's customer portfolio in telecom sector. So generally there has been pressure on Q1, and it gets marginalized as we progress through other quarters.
So
Q4 is the heaviest in telecom. Yeah.
So in Q1, your margins were under pressure. I think consolidated margins were about 17.5%, 18%. Has there been a recovery in margins since? And if yes, if you could tell us what was driving it?
I would again say that Q1 is a different quarter for us, and overall margins over years, annual margins would be healthy, and we will be maintaining these same margins.
Okay, so if you leave out Q1 and the rest of the margins, I'm seeing for Q4, it was at around 20%. Before that, we saw around 30%. So what kind of levels should we expect now?
We'll be maintaining same margins of around 27 to 28% by the end of the financial year. That much I can share, because we have started taking up more projects, and the share of projects is also growing as a part of overall revenue for us. But I'm sure that we'll be maintaining same margins.
Okay, Mr. Kumar, we'd love to chat with you when you could share some numbers. So do promise us the Q2 interaction once your numbers are out. And then we'll get a greater clarity on what the FY23 outlook looks like. Thank you very much for joining in. That's RailTel for you. Need to slip into a very short break. On the other side, we'll come back and discuss markets.
HDFC Securities, who joins in now to talk about the market fundamentals and, of course, where do you put your money? Hi, Unmesh. Thanks very much for joining in. The global setup is, it has been volatile, right, for some time now, no surprises there. But how much worse can things get from here? And in terms of impact for India, what are you betting on in terms of, where allocation should be? How much can volatility spike from here? Should you move to cash? What is your house view now?
Okay, so look, volatility has been high. We don't see that changing. In fact, if you see what's been going on, what we have been expressing not on this channel as well for the last 2 or 3 months is that we saw a false dawn, so as to speak, in September, when there was a view that there has been a dovish pivot by the Fed. We always thought that was not going to last, so it's played out that way. To some extent, the markets come off, so it's a good thing. But having said that, we believe there are two very important factors. One is that the volatility will persist. The central banks globally, if you look at what's happening between Japan, China, EU facing its own problems with central banks as well as governments, as well as the Federal Reserve, and of course, eventually India, very different drivers. So the coordination of central banks, which had become something that the market had taken for granted since 2008 after the fight against the global credit crisis, is something which is broken down. Now, in that case, what happens is that every time someone says something, volatility comes back into the market, and we can't see that change because the inflationary pressures also on different countries is different at this point in time due to various geopolitical and other factors. So will that change? We think not. The good thing is that the market was well over one standard deviation, maybe at around 18.5. What we are currently seeing is that it's cooled off a bit. But at the same point in time, if you look at the number of imponderables that are there in the market, usually you are comfortable investing, when you can actually start thumping the table is really one standard deviation below. Now, that may be a fair distance. So the correction in our view is not over. We continue to believe this will go on, but it will also not be a straight line, because there is no dislocation in the global market. So what will happen is that it will be a slow grind downwards, we believe, which we believe will continue.
All right. Hi, Unmesh. Good morning, and thanks for joining us. This is Pavitra. So, in this situation, then, what are the sectors where you feel you're perhaps most comfortable putting some fresh money to play? Financials have been a sector which have, been favored for a while now. Do you think that is still a good bet?
Yes, indeed. So, to answer also part of the earlier question, we work for institutional equities. We don't believe in actually sitting in too much cash. So if you look at our model portfolio, it has 3% cash today. I don't expect that to go up significantly. We've held a little bit more for short periods of time, but really that's where we continue to believe. We believe the way to invest in this is twofold. The first thing to keep in mind is that we believe that whatever we are going through is basically, the action by the Federal Reserve to induce a shallow recession to achieve price stability. Okay. In that context, this is not like 2001 or 2008 or even 2020, where we believe that there will be a very serious contagion spreading from financial markets into the economy. So we are looking at a normal kind of cycle, maybe a long grind maybe towards it, maybe for the next 12 to 18 months, but that's what will happen. In that context, the best way to invest your money is to invest in thematics. Now, how do we do that? Our model portfolio has two very strong calls. One is that we prefer value. And the second is the big call that our research team has taken is industrials over consumer. And which is why, and all the derivatives of that. So what you will notice is that our largest overweights are large banks, industrials companies, real estate, and then there are thematics, which we believe will continue to play out through this entire period. So financial inclusion, which can be played through insurance or capital markets. We have the city gas players, and we believe that the ancillary benefits of all of this, which is the cement sector. So that's basically where we are investing at this point in time.
Okay, Unmesh, you also said, you're looking at value. Then at a time like this, when a lot of the IT stocks have corrected 40-50% from the peak, does that space also seem attractive to you? Or do you think that, there is maybe room for a lot more of a fall and there could be a better time to get in?
Yeah, so you're right. That's a tough one because of the, so there are two issues here, right? The currency, thankfully, is not creating a problem for them, not at this time. What you do have is that we have a large research team. Apur's written a very good report on the demand drivers for IT. In our model portfolio, given the valuations, we have been around 200-220 bips underweight now for a while. Okay, and that's to some extent played out quite well. But if you look at the longer term drivers, we are quite confident that the adoption of cloud, digitization, and the larger themes within that. The fact that the Indian companies are slowly climbing the value chain. Would you want to remain invested in the space? The answer is yes. Is it an overweight at this point in time? Answer is no. What we are doing is that, and relatively we have a call of Infosys over TCS, which is the relative weight that we have in the model portfolio. So we are very selective. We believe that we should start looking at the space, incrementally put money to use. But so while we have held an underweight stance, we believe that the correction in valuation and the fact that we have fairly good visibility on the longer term drivers. So we are very confident that 3 years from now, it will be a good call to have taken. Maybe from a timing perspective, you could get it a bit more right, but we are positive on the IT space in that sense.
Okay, just one final question. You were saying you're positive on the IT space. One final question I want to ask you is on the metals pack as well. We have seen a decline there, of course, after a big run up as well. But the commodities are a whole different play, right? Do you have a call in the metal space as well?
No, we are underweight. We did miss a part of the rally, of course, but at the same point in time, we are underweight. We're quite comfortable doing that. We believe the easiest way to look at that is that the two key drivers usually for metals is one is the financialization, because to a large extent they are risk assets now, usually clubbed with emerging markets, and we believe that we are in a risk-off environment. We believe that will continue. So that's one very big negative from that perspective. And the second is if you look at the demand drivers, right? The only risk to our call really is whether when China opens up, what happens, because right now obviously there's a lockdown ongoing over there, but that could be a short-term rally. If you look at structurally, there has been a fair bit of demand destruction where globally the larger countries seem to be wanting to slow down their economy. So in that sense, while we do have some names in our model portfolio, I think we have Hindalco, Tata Steel in there, but they are all underweight. They are all underweight positions, and we're quite comfortable with that.
Underweight on the metals. Unmesh, thanks a lot for joining us today and taking us through your call in the market as well as all of these individual sectors. So they do like some of the industrials, some of the financials such as the larger banks, and some select IT names as well, but they're underweight on the metals pack. So with that, we're going to get into a short break now. But as we do that, here are some great news for our investors.
Today, Infosys board will be meeting post-market hours where they will consider earnings as well as a buyback. So purely in terms of numbers and the expectation, a dollar revenue growth of 3.1%, constant currency revenue growth should be closer to 4.5%, 4.6% is what the street is anticipating. There will be some improvement seen on the margins on a quarter-on-quarter basis due to the residual impact of wage hikes. So Q1 margins were impacted because this is the poll as of, these are the margins as of Q1. This quarter, we're expecting margins to come in at 20.5%. Q1 margins were impacted by wage hikes given to junior employees, but Q2 will be impacted by wage hikes given to mid as well as senior employees. The key is going to be the guidance for FY23 guidance. Our revenue guidance at 14 to 16% is likely to remain intact, while the margin guidance too is likely to see any change, unlikely to see. So 21 to 23 is what the street is anticipating. So FY23 revenue and margin guidance is likely to remain unchanged. The street is going to be tracking very closely what the buyback amount is going to be. Now, the last two buybacks were by Infosys were about 9,200 and about 8,200. But this time, the street is anticipating that the buyback amount could be larger, closer to 10,000, 11,000. That's the IFL estimate. And that's because if the company needs to meet its stated capital allocation policy of 85% over FY20 to FY24, then they need to speed up and give some more, return more by way of buybacks as well as dividends. So the street is a bit optimistic on the buyback amount. Let's see whether that can come through. But that's the expectation as far as Infosys goes.
All right, Rima, thanks a lot for running us through all of those estimates. We are going to wait by for those numbers. For the market, we have only slipped further. It's a 150-point cut that we are seeing on the Nifty right now. 16,970 is what we have on the index. The Nifty Bank is where a lot of the pain is, 1.6% lower. In fact, take a look at some of the financials. So the likes of SBI, you have ICICI Bank, IndusInd Bank, which have all slipped sharply. Wipro has also seen its losses extend. So it's now almost a 7% cut that we are seeing on Wipro. And Adani Ports is the other one, which has slipped even further down almost 3%. That's what's happening as far as the losers go. For the gainers, it's only around 8 stocks which are holding in the green, and only Hcl Tech and Hindalco with gains that are, worth speaking about. But that's what's happening in terms of the market action. We're going to wind down on trading hour. But as we do that, we leave you with some market opinion from Steve Bryce of Standard Chartered Wealth Management. Thank you for watching. Halftime Report is up next.
There was a little bit of a hint of maybe calibrating the pace of rate hikes at some indefinite point in the future. But for now, the focus is definitely on a 75 basis point rise. But if you look at the VIX index, we're at the highs for the year, and from that perspective, this is an important number to see. If even if it doesn't, surprise on the positive side, i.e., fall significantly, then I think markets might take temporary relief from the numbers. The first thing I'd say is, look, we are most likely to see a policy mistake here, right? So we have a 75% probability of a recession in the US over the coming 12 months. So that's our view in the CIA office. So even absent a financial shock, that's obviously not a great outcome or a great environment. The thing that makes us probably a little bit more concerned about whether that will be deep or maybe more lead to financial fragilities is just the pace of tightening. We've never seen anything, certainly not in my lifetime, something like this before, and it does risk uncovering things that we're not aware of. We're overweight India within Asia ex-Japan, so that's still our stance. Obviously, we're not hugely bullish on oil prices from here, so that's a positive factor. I know we had the inflation print today, but we do think inflation is going to come down, so that should lead India to outperform.